Everyone again, Bob Thompson here, founder of Thompson Investment Partners, and once again, midsummer here, we have Martin Danielak on the call with us to talk about markets and do a quarterly review of markets. We're also going to talk a little bit about advanced planning at the end, which I think is equally as important as what's happening in the markets. And I guess with that, let's get started, Martin.
Thanks a lot, Bob. Good to be here again. And of course, in today's video, as you touched on, we want to have a recap of 2024. We're going to discuss some recent shifts, some big market shifts that we've been seeing, as we've talked about a sea change in the past. So we just want to bring that to the forefront again. And then lastly, we want to touch on our advanced planning process and talk a little bit about our next video to follow this. So
Sure.
let's start off with the markets, Bob. What's been happening so far this year?
Yeah, we've been talking for a better part of a year and a half now about changes happening in the market and why they're happening, and I think we're starting to see that creep in more and more and more in the last quarter. So what I'm, what we're kind of seeing is that we've mentioned it many times before. We're looking to where the puck's going to go, not to where it's been, and it's been a strong bull market or up market in kind of lots of securities that traded high valuations or maybe growing rapidly, and that's been a surprise to people that's continued because when interest rates are low, that's definitely the case. When interest rates go up a lot, that isn't necessarily the case. But usually those stocks don't do well, but they're still stretching out their gains here. It's like the rubber band. The more you stretch out the rubber band, the faster it snaps back the other way. So I think we're in those last stages of the rubber band stretching, either before it breaks or snaps back for a lot of the stocks that have been kind of leading the way. And I use an analogy. I've used it many times in the past. I think it's a great analogy that a bull market, in other words, an up market, the stronger the bull market, the harder it is to kill it, right? And I think that's just like with a real bull. The stronger the bull, the bigger the bull, the harder it is to weaken it. And that's why this bull market keeps coming back and back. But each time it comes back to us, it's a little bit weaker than it was before, right? So that's when we see this great rotation, and we can talk about that more in a bit. But I think we're starting to see that happen right now, actually.
Yeah, I think the market's really been driven by the continued government spending. On one
Mm,
end, they've raised interest rates to slow down the economy, and we're starting to see that happen. But on the other end, they've been spending so much money continuously, even here in
mm.
Canada, and that's kept markets liquid and certain areas doing well. But surprisingly, like you said, growth had done well in higher interest rate environment, but gold has been one of the strongest asset classes this year in a high interest rate environment. So what could that just be telling us on the whole?
Yeah, and I think that's a great point that you just brought up, Martin, because that's probably the reason that, a lot of these stocks have continued to do well in the economy. I think it's debatable, but it looks like the economy is doing okay. I think if you actually look under the hood, it's not really that healthy, but there's two reasons for that. One is, they raise interest rates to slow down the economy. That's why you raise interest rates. And it on the surface, it really hasn't worked that well. You know why? Because they've got trillions of dollars of deficits that the government's spending to to try to keep the economy going. So isn't that interesting that the government is kind of working against the central bank and wasting trillions of dollars in the meantime, really. But there's a reason for that, and this is common in the last year of a presidential cycle. So it doesn't matter whether it's the Republicans or the Democrats, the liberals or the conservatives. Um, what they try to do in their last year is make it look really good, buy a lot of votes so that they can get in power again. And it's just a function of what happens. So coming off the other side, it, things aren't great, and that's why interest rates probably start to go down. But you mentioned, kind of some of the commodities, maybe the U.S. dollar and gold. Um, when they start to lower rates, usually the dollar will start to go down, the U.S. dollar. Now, I know we're all Canadians listening to this, and we think, oh, Bob just said the Canadian dollar is going to go up. Not at all. The US dollar going down means it's going down against a basket of currencies. It's not necessarily just going down against the Canadian dollar. So the US dollar could go down, but the Canadian dollar could go down more, right? As opposed to the US dollar. So um, I think that's important to mention. But yeah, I mean, we've been talking gold for a little while, and we only have a small percentage of people's portfolios in that area. But I think that's going to be something that leads coming out, and it's been a surprise to people in the last few months. We talk about gold because gold, I actually think, is the smartest asset in the world. In other words, gold reflects what's happening in bond markets, what's happening in currency markets, what's happening in financial markets in general, what's happening to the economy. It's all factored into that price. So that's why it's always been an important price, and that's what that's what we look at. But it started to do well, and it shouldn't have been doing well yet. It should start to do well when the market forecasts that rates are going to start dropping. So right now is actually when gold should start to do well, and bonds should start to do well because they're forecasting that the Federal Reserve is going to reduce interest rates in the U.S., but we can talk about Canada too. So I think the reason it's done so well is we've had this push and pull there too. So we've got this proxy war going on, as I like to say. We've got the Chinese central bank, um, Chinese consumers and Indians buying a lot of gold, and in the West here, we weren't expecting gold to do well. So we're kind of fighting it to keep going down, and they're fighting it to go up by buying it. And that's been the push and pull. And so far, the East, Chinese, Indians, the consumers have won because the gold price has gone up when a lot of people didn't think it was going to go up.
And now we're starting to see some buying finally here in the US and
Yeah.
North America, primarily through the
Mm.
gold stocks, as we've mentioned before. Um, so that's been a very positive sign
Hmm.
in terms of the new bull market. It's definitely begun. It's on its first or second major leg, so we'll see where it goes from here. Back to the economy, we know the market isn't the economy because the economy could be slowing, the market could be going higher, and vice versa. Let's just touch on how the Canadian economy is doing and maybe just focus a little bit on inflation and employment.
Well, lots of people have been calling for the death of the Canadian economy for a long time. Um, but remember that it's cumulative, right? So, as they say, sometimes the difference between being wrong and being early is indistinguishable. So, in other words, just because you've been saying, people have been saying maybe the Canadian economy is going to be weak, and it hasn't been, it's going to happen, right? Because it's a cumulative effect, right? It's not kind of a binary effect, right, wrong. It's a cumulative effect. So, yeah, I mean, consumers in Canada are struggling very large because um, they're over indebted. Okay, inflation's been high. A lot of people on variable rate mortgages, even if they're not, they're having to renew their mortgages at a higher rate. At the same time that unemployment is increasing. That's a recipe, not a very good recipe. And I think, from the chart that you see there, the inflation rates come down, but you get another bout of it, especially with government spending. And the number of government employment has gone up dramatically in Canada. Immigration has brought in 1 million new immigrants, which is a massive number for Canada for 2 years in a row now, and that's great. But similar to the U.S., where they're running these huge deficits, here in Canada, those have been kind of one-time shots to help the economy. And unless that continues, then we're going to start to see some issues. So, the Bank of Canada has dropped rates one time, and there's a little bit of relief for people there. Um, but I will say that whether it's the Bank of Canada or whether it's the Federal Reserve or the Bank of England, almost all the time the central banks are behind the curve. In other words, what I mean by that is they reduce interest rates too slow or too late and too slow. So then they have to panic and start reducing rates dramatically. Because remember, everything is a trailing effect, right? When they raised interest rates, it didn't have much of an effect for a year and a half. So when we're starting to see weakness in the economy, that's kind of showing us what happened a year ago, right? So, and then they start to reduce interest rates now based upon what they actually see. So of course it's too late. So you start to see the economy do poorly. Now, there's a difference, and I think we were going to talk about maybe the economy versus the market also.
Yeah, completely. Um, Yeah, the market's continued higher, but certain areas of the market, as we've seen within consumer discretionary, paints the same picture that we see here. You're seeing the higher end
Mm.
consumer who's done well and has their cash and investments in GICs making 5% versus, the lower end consumer, which is unfortunately most people in our economy, are
Mm-hmm. Mm-hmm.
struggling with higher inflation, mortgages, and everything else. So if you look at a lot of stocks and companies of areas where these people shop, whether it be Nike or Lululemon, just for simple retail names, and you'll see that there's been a huge decline in the last 6 months, really showing that these consumers have shifted away from discretionary spending to consumer staples. And that's why you see grocery stores and even tobacco companies doing very well over the last 6 to 12 months.
Right, and I think that's a trend that's going to happen going forward. And in the case of the Canadian stock market, interesting enough, we're all interested in that because we live in Canada. We could see a scenario where the Canadian economy does pretty poorly, but the Canadian stock market does pretty well. Isn't that interesting, right? So they aren't necessarily correlated. And the reason for that is Canadian stock market has a lot of metals and minerals. It has energy. That's a big chunk of the market. And if the U.S. dollar declines, those start to do well. That's gonna maybe be a good thing for the Canadian market. But again, there will be a rotation. There'll be a shift. What will start doing well in the Canadian market is things that haven't done well in the past. And I think that's what's really important. Keep your eye on the ball going forward, not what's just been going up.
So we've talked
Yeah.
about governments and central banks continuing to support the economy no matter what, but that they are late. So, what major shifts are we seeing in the market? Investors seem to be anticipating moves ahead of time. So,
Mm.
what have we seen lately in the market, and perhaps what is this telling us?
Yeah, I remember history doesn't repeat itself, but it rhymes. I've said that a lot of times. So I really, really, really study my history, right? And nothing is exactly the same as it was in the past. But, I've been doing it almost 30 years now, and you start to see the same cycles happen over and over. And, I know I've talked about it a lot, but I'm going to mention it again. Back in 2000 to 2001, 2002, we saw a very similar situation, 1999 into 2000, where these sorts of, the stocks that have been doing really well that everybody's talking about, and believe me, we know, right? Because we hear it from clients, we hear it on the news, we hear certain stocks, and I absorb all of that and take it in, and that helps to make my thesis going forward. So we're in a very similar situation to what we were in 99, 2000, not exactly the same. But I would say probably less than 10% of people in the market today actually live through that and understand what happened at that time. So that's why things happen over and over again, right? Because if everybody remembered everything from last time, they wouldn't do it again. But people haven't been through it. So what happened in 2000, 2002? The U.S. stock market did really poorly. Canadian stock market, in some respects, did kind of poorly too, because you had Nortel at that time, which represented a big chunk of the market, and went to zero. Um, but there were a lot of stocks that actually were undervalued and started to do well. So value managers that bought stocks with a margin of safety, right? Bought stocks that weren't over leveraged, bought stocks that weren't growing rapidly but traded at good valuations. They actually made money from 2000 to 2002. And that's what we're doing. You and I are in clients' portfolios. We're adding to value stocks. We're adding to managers that are value managers because I think a similar sort of thing is going to happen. Now, the blueprint isn't exactly the same, but interesting enough, recording this today on Wednesday here. What's the date, Martin? It is
July 17th. Yeah.
July 17th. Interesting enough, one day doesn't mean anything,
Mhm.
but we've seen this massive rotation today, and value stocks are up. They're doing extremely well, and all the stocks that have been pulling the market forward for the last year or two are all getting hit very, really hard today. And I think that's important because I saw somebody say, this is the tremor before an earthquake, right? Now, an earthquake isn't bad. I don't want people to get concerned about that. What we mean by that is just this rotation, this shift. So we're involved in the things that I think the money's going to come into, right? We're not involved in the things that the money's going to come out of, I think, going forward. So we're in a real interesting time right now, especially going into the election.
Yeah, it was interesting because it basically started last week, Thursday, right
Mm,
after a low inflation report in the US. And that shows that the economy's cooling.
mm,
And that warrants that central banks in the US can start lowering interest rates. They now have a
right,
reason to. So you're seeing people get ahead of perhaps the stimulation that happens afterwards. There might be
right.
some economic weakness. We might have a soft, hard landing. There's a lot of scenarios that could pan out. But I think one certainty is that rates are going to head lower, and it's either if they head at a slow pace or all at once. So we'll see what happens. But before we move forward, I just wanted to share. You mentioned, 2000 to 2002, and I wanted to bring up, perhaps what were the strongest and weakest asset classes in that time, because a lot of money came out of U.S. large caps following 2000, the previous leaders, and money really went into areas such as, value exposures like real estate, gold. But then after that, you really had international stocks become leaders, true global stocks, better value oriented. And a big reason was the decline of the US dollar over that period of time. So if you want to just touch on it a little bit more.
Yeah, interesting new information probably in the last few days too, and we'll get into that chart, is that depending upon which governments come up, that we've had a vice presidential pick for the Trump administration if they get into power, and the vice president has actually written lots of reports in the past about devaluing the dollar. He wants the U.S. dollar to go down, and Trump's talked about that too. So whoever gets in November, at least one of them wants a low dollar, and if the U.S. dollar goes down, sure, that's how this chart will play out, right? Commodities do well, emerging markets do well because emerging markets are generally more dependent upon the commodity markets, so they start to do well because their currencies rise up in value and things like that. So I think it's playing out the path forward to what this chart has said here. So yeah, when we say international stocks, we mean ex-US, right? So Canada is actually international stocks with regard to this chart here, right? And European, obviously Asian stocks, Latin American stocks, Australian stocks, etc. Um, they tend to do well when the U.S. dollar goes down. Now we've had a high. I remember I mentioned history doesn't repeat itself, but it rhymes. But the U.S. dollar against a basket of currencies actually peaked within the last year and a half, very, very close to what it was in 2000, right around the same time, right? And when the dollar started to go down after that, all these other things started to play out. So that's why I think that's going to happen here. But these sort of charts are very, very, very interesting because you can see that most people, it's not many people, it's most people, almost all people chase returns. They chase whatever has just done the best in the last year or two, thinking that it's just going to continue to go. And we know, everybody knows the saying, nothing goes up forever. We all know the saying, nothing goes down forever. But that's what we do. We chase returns on the upside and downside. So you can see here, that in various of these years, sometimes there was 2 years in a row where I don't even see anything there, but that small stocks or large stocks or gold, did the best. Usually it alternates though, back and forth. And if you get a clump of one asset class doing, not first, but one of the better ones for 2 or 3 years in a row, you're going to pay for that, right? It's going to give back some of those returns, and it's going to go to something else. And that's exactly where we are right now. I realize this is an older chart, but we're in that scenario where U.S. big stocks have done the best for 2 or 3 years in a row. You're going to pay for that. They're going to give a lot back, and the money's going to be flowing somewhere else.
So I think this is great for clients to understand. I think it adds a lot of color in terms of what we're
Hmm.
doing. So let's just switch gears. In your last interview with Ben Mummy, it was a
Hmm.
great interview. So we'll provide a link to that as well. I think it goes a lot deeper in investments and markets for anyone interested. But one thing at the end that you stated was, success in life is not about building wealth solely. It's about positively changing lives, and that really resonates with our approach as, we believe that we're holistic wealth advisors and we do much more than manage investments. It's just one piece of the puzzle. So let's talk a little bit about advanced planning and perhaps some initiatives that we have for the second half of the year.
Yeah, yeah. It's a great point to bring up because what happens to the markets and how you react is, important, but not necessarily debatably the most important, right? The most important is what are your goals? What are your objectives? Stay on target, get to your goals and objectives, because you can control all of that, right? You can't control what happens to the market on a day-to-day basis. So let's worry a lot about what we can control, and that's called advanced planning. And I think that's important because advanced planning steps. There's four of them basically, and here at Raymond James we have departments to support us so we can accomplish all of these steps in-house, which is uh, really good I think for the end client. But as you see here, this is a sample couple, Dan and Lauren, and our clients, all of our clients have one of these advanced planning documents that Tanya um, um, changes as we do various things for the client. So this is a living document. It's constantly changing, and I think that's important to stay on track. So here's a sample couple, Dan and Lauren, and there's four areas that are important. Wealth enhancement, and right, that's what we're talking about. That's the markets. That's minimizing taxes. It's using corporate class structures. It's getting dividends instead of interest. It's all of those things that are important to enhance your wealth, doing a financial plan, etc. So for this sample couple, Dan and Lauren, as you see, the green ones means we've done them, the orange ones are we're working on, and the white ones are future actions that we're going to do. So it really helps us to stay on track. Wealth transfer, and Tanya facilitates a lot of this. So, you and I talk about markets, but equally important, Tanya facilitates all of this for clients. So, wealth transfer is the next one. You see, that's estate planning. How am I going to pass on my assets in a tax efficient manner, avoid probate, etc. Um, and we have Patricia Chartrand that does that with our team. She's a trust officer here at Raymond James, and wealth of knowledge. She's talked to many of our clients, but wealth of knowledge over her 25, 30-year career being a trust officer. Wealth protection, really important. So that might include insurance, might include having a holding company. It might include shielding your assets somehow from liability, whatever the case is. Um, so, there's three or four steps in that wealth protection, not applicable to everybody. Sometimes opening up a holding company for an individual, if they don't have a complex situation, isn't applicable. So we wouldn't do it in that case. But obviously, these are things we look at, and this is a checklist. A lot of clients know that I've been a pilot since I was 16 years old, and it's very important when you're a pilot to follow a checklist. You always look at the checklist, even if you think you remember it. This is a checklist for advanced planning. The next one is charitable giving, and charitable giving, if people have charitable intent, and say, hey, I want to make the world a better place by giving to somebody maybe less fortunate. There's ways to do that in a tax efficient manner. So charitable giving actually can enhance your wealth. It can protect your wealth. It can help to transfer your wealth also. And, again, here at Raymond James, we have a Raymond James Foundation, and we have financial planners that are actually specifically assigned to the charitable giving part of financial planning. So I
That's
think that
great.
covers most of it on advanced planning anyway. Yeah.
Exactly. And you mentioned Patricia Chartland, and that's the person that we're going to engage for our next video. She's our senior trust officer, and she's a wealth of experience. We've worked with her, many of our clients to assist them in wealth transfer and protection. So yeah, look out for that video
Mm.
over the next month or two, as we'll bring her in and we'll ask a lot of questions in terms of, what are clients facing now? What are some major shifts and changes that we're seeing in policy that might impact how you go about wealth transfer and wealth protection?
Right. Right. No, I think that's it's very, very important. Patricia's a great presenter, so I'd love to have her on a call in the future here. And I'd love to have Tanya on sometime. I know Tanya's a bit shy about coming on, but we'll have her on one of these days. Talk about what she does for clients too.
Yeah, I think it'll be a perfect video for both of them to
Yeah.
come on. So we look forward to, really introducing our team as a whole, and really seeing the bench strength that we have here at Raymond James. So, with that being said, I thank you all for tuning in today. I hope you found this informative. If you have any questions, just please reach out, give us a call, shoot us an email. We're always around. And yeah, I hope you have a fabulous rest of your summer.
Thanks again, as always, Martin.
Thanks.